Welcome to another edition of the Savant Investor. Please support us by subscribing. What are the 8 biggest factors that impact your credit score? 1. Payment history. 2. Missing payments. 3. Credit utilization. 4. Using too much credit available. 5. Length of credit history. 6. New credit. 7. Having multiple open accounts with balances. And 8. Credit errors. 1. Payment history. Payment history is more important than any other information. It's worth 35% of your FICO score. The fact that your payment history matters so much isn't surprising when you take a moment to consider the purpose of credit score. Credit scores help lenders predict the likelihood that you'll become a 90 days plus late on a payment during the next 24 months. If your reports show that you have done a good job keeping up with your credit obligation in the past, your credit score will almost certainly reflect your hard work. 2. Missing payment. It's critical to make all your payment on time every month. Even one 30-day late payment has the potential to hurt your score. If you frequently make late payments or fall more than 30 days behind on payment, the credit score drop could be severe. Credit scoring system evaluate 1. Whether any late payments appear on your reports. 2. How late those payments were, 30 days, 60 days, or 90 days. When the late payment took place. The more recent, the worse the score impact. How many late payments appear on your reports. Automate payments can be a great backup system to save you from oversight in those late payments. 3. Credit utilization. Your credit utilization ratio is nearly as influential as your payment history in terms of credit score importance. Say your credit report shows a credit card with a $10,000 limit and a $5,000 balance. In this example, your credit utilization ratio is 50%. Why do credit score models care about credit utilization? It has to do with risk prediction. Statistics show that people who use bigger portion of their credit card limits are more likely to pay bills late. The lower your utilization ratio, the lower your credit risk. If you want a good credit score, you should pay your full statement balance each month, preferably before your account statement closing date. 4. Using too much credit available. When you use too much of your available credit limit, your utilization rate starts to climb. Building on the example above, imagine you charge an additional $2,500 on your credit cards. However, you don't pay down your balance aside from the minimum payment. That move won't be good for your credit score or your bank account. The extra spending would cause your utilization ratio to jump from 50% to 75%. When your card issue, send your account information to the credit bureaus. Under FICO credit scoring model, you should aim for a utilization ratio of less than 10%. People with the highest FICO score have an average utilization ratio of 5% or less. Again, a good way to keep your utilization level low is paying off your credit card before your statement closing date. Sometimes, bank will do you a favor by raising your credit limit. A higher limit may have the benefit of automatically lowering your utilization ratio. Length of credit history. Your age does not have an impact on your credit score. The age of your accounts, on the other hand, is relevant. FICO bases 15% of your score on your length of credit history. Some of the details FICOs consider in this category include the age of your oldest account, the average age of accounts on your credit reports, how long it's been since you have used the accounts on your credit reports. Having older accounts work in your favor in this credit score category. But if you don't want to sit back and wait for time to do its magic, you can ask a loved one to help you out. Becoming an authorized user on a friend's or relative's credit card might increase your length of credit history and, by extension, your credit score. Just be sure that your loved one adds you onto a credit card with perfect payment history and a low credit utilization rate. Otherwise, being an authorized user might move your credit score in the wrong direction. 6. New credit. When a financial institution pulls your credit score, a record shown as an inquiry is added to your credit report. Most inquiries stay on your report for 24 months. Some inquiries, known as hard inquiries, have the potential to damage your credit score for 12 months. Here's a tip. Checking your credit score and report will never hurt you. Studies show that people who apply for a lot of credit in a short period of time are riskier borrowers. In other words, they are more likely to pay a credit obligation 90 days late in the following 24 months. The logic is as follows. The more credit you apply for, the more it appears that you need money. If you apply for a lot of credit at once, it can make you look desperate for cash. This may raise a red flag with credit card issuers and other lenders. Some people apply for numerous credit cards at once to accumulate a lot of points in a short period of time. This strategy can have negative implications for your credit score. Sure, in the short term, you might accumulate a boatload of points, but is putting your credit score at risk really worth it? In our opinion, the benefits don't outweigh the potential costs of a damaged credit score. 7. Having multiple open accounts with balances. You might not realize that the number of accounts with balance on your credit report can impact your credit score. Fewer outstanding balance is best from a scoring perspective. For this reason, it can be helpful to start with your smallest balance and work your way upward when you're trying to pay down debts, credit cards or otherwise. Consolidating multiple high-interest debts with a personal loan or a balance transfer credit card could help you in this area as well. Not to mention, it might save you money. 8. Credit errors. Credit reporting errors happen all too often. The Federal Trade Commission released a study on credit reports accuracy and found more than 25% of consumers had an error on at least one of their credit reports. You can always prevent credit report errors from fraud or identity theft. You can't control whether creditor reports bad information to the credit bureaus. Some credit reporting errors, like mixed file, are even caused by the credit bureau themselves. However, you can take steps to protect your credit and fix problems when they occur. First, check all 3 of your credit reports from Equifax, TransUnion, and Experian often. You are entitled to a free report from each bureau every 12 months via the annualcreditreports.com. When you download your reports, go to them line by line. Make a list of any mistakes. Even errors that seem minor might be relevant. If you find errors, you can dispute them with the credit bureaus. According to the Fair Credit Reporting Act, the credit bureau has 30 days to investigate your dispute, 45 days in certain cases. At the end of the investigation, the credit bureaus must either verify that the item on your credit report is accurate or delete it. The Consumer Financial Protection Bureau provides a helpful guide to walk you through the dispute process. Additionally, if you want to lower the chance of someone opening a fraudulent account in your name, consider freezing your 3 credit reports. You can freeze your credit report for free and it will block future lenders from accessing your credit information. When you want to apply for legitimate credit in the future, you will need to unlock your credit reports first. Although unlocking your credit reports before new application requires an extra step, it's well worth it for the added protection against this type of fraud. What's the bottom line? Your credit score matters. Good credit can save you thousands of dollars throughout your life. Good credit may also help you qualify for attractive offers from lenders such as premium travel rewards credit cards for a fancy vacation or super low mortgage rate, which could save you thousands of dollars over the life of the mortgage. If you currently have less than stellar credit, don't despair. There's still some travel reward card that you might qualify for with low credit score to build up your FICO score slowly. In the meantime, keep a close eye on your credit reports. Avoid the mistake outlined above and study additional ways to improve your credit for the future. Staying on top of your payment can bring an excellent credit score within reach.